Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's look ahead to Friday's big core PCE reading coming out of the US. Of course, coming off the back of a PPI number that came in higher than expected not so long ago. Concerns around inflation have really been rearing their head once again, with implications across different financial markets. So I'm going to take you through what markets are expecting, what it could mean for markets, and really highlighting some of the potential moves that we could see around this. First and foremost, like I said, I want to take you through what markets are expecting. This is the trading economics calendar. Expectation is for a decline on a monthly figure to 0.3 from 0.4 last time around. And in terms of that year-on-year figure, that's 2.7% from 2.8. It's worthwhile really focusing in on that month-on-month figure because, of course, 12 months in a year, it means that if you see a number around about 0.2, 0.1, then you're going to be getting back towards target. As long as we see month-on-month figures of 0.4, 0.3, that is tracking above 2% target because, of course, 0.2%, 12 times over, you'd be looking at around about 2.4% for the annual figure. So we need to see 0.2s and below consistently to point towards a decline back down to target. Now, in terms of the big breakdown that we have here, the comparison between core CPI and core PCE does highlight that PCE is ahead of the game when it comes to a move back in the direction of target. The Federal Reserve, of course, do favor this core PCE metric, so that is a good thing, and perhaps this is why the Federal Reserve have appeared to feel relatively calm despite the fact that inflation does appear to be tracking higher than they would like. Certainly, the middle section of this does highlight just how concerning last month's reading was 0.416, well above anything that we had seen over the prior year. And we're used to seeing figures between that 0.1 and 0.2, which, as I said, puts us on track to hit that 2% target before long. If you look at the bottom section, 8-month annualized does put us on track to move towards 2.3% in a few months' time. But that's not necessarily 2%. And it really does come down to whether the Federal Reserve need to see that 2% target hit. More recently, they have been coming out with a relatively calm tone, as I think they're quite happy that they have managed to rein in markets from expectations of 7 rate cuts this year. Now markets pricing a first rate cut in June with 3 this year, so 75 basis points in total. Whether that comes to fruition or not remains to be seen, but certainly this pricing around rate cuts does continue to impact a number of different key markets. And I just want to first and foremost strip some of them out and just show you the US 10-year Treasury yield is one of those key markets that if you're looking to see what markets perceive in terms of interest rates, this is one of the key markets to be looking out for. What we saw here is this massive decline in terms of yields at the back end of last year, highlighting that move in confidence away from that big rise in inflation. As we saw inflation coming down in a meaningful manner in Q4, markets suddenly started pricing, rate cut in March, 7 rate cuts over the course of the year, and start to get a little bit ahead of themselves, really. And what we've seen since then, and essentially in 2024 thus far, has been a reversal of that. So an easing of those expectations from 7 rate cuts this year to currently 3 rate cuts this year. And so if you're expecting to see the Federal Reserve cut less than that, so let's say markets are currently pricing in 3, but you think, well, we're not going to hit inflation, the inflation target anytime soon, and the Federal Reserve won't cut rates in June, and we may only see 1 or 2. Some people are saying we might not see any rate cuts this year. If you are in that camp, then it points towards the likely upside for the US 10-year. So if we see upside for the US 10-year, maybe you don't trade that market, but it does have a close correlation to a number of other markets. And so this can form the basis of your outlook for other markets. So are we going to see 3 rate cuts this year? Well, this core PC inflation metric, if it comes out at 0.3, I think that furthers the idea that we aren't about to hit that 2% target anytime soon, and that June seems very unlikely for us to be at that target. So there's question marks around whether we will see 3 rate cuts. So if we see a lofty inflation reading, 0.3 on the monthly, 0.4, that would likely push this US 10-year upwards once again. And what would that do to different markets? Well, this is the dollar index tracked against the US 10-year. As you can see here, very close correlation over the years. And this has been tracking it well recently. The regaining of ground in the US 10-year has fed into gains for the dollar index. Now, we've seen this pullback recently in terms of the US 10-year that we saw in early March, in actual fact, lead to a more dramatic pullback in terms of the dollar index falling back below the prior swing low that we had here. That wasn't necessarily the case in the 10-year. And this does point towards the idea that, maybe we see a little bit of additional upside in terms of US 10-year as 3 rate cuts turn into 2. But we're unlikely to see the same kind of gains that we've seen over the course of Q1 thus far, because that was a realignment from 7 rate cuts to 3, right? So we have seen a massive realignment in terms of market expectations. And therefore, gains in terms of the US 10-year are likely to be more tepid compared to how we have seen them in the past. And you can see that. Let me just hide this once again. You can see that with the fact that we're not necessarily creating higher highs at the moment. We're trying to push upwards, but there's question marks over how far any such push might go. So if we see a strong inflation gauge coming out for the core PCE metric, that could provide upside in terms of US 10-year yield and upside in terms of the US dollar. But there's question marks about how long it could last. And ultimately, once we get into the thick of it in terms of actually moving into rate cuts, and if the Federal Reserve essentially come out and say, well, as long as we're in the ballpark region of 2%, we're happy to cut rates, it's likely we'd see yields roll over, the US dollar roll over. And what other markets are impacted by this? Well, let's get rid of the US dollar and instead look at the S&P 500. Well, sometimes this tracks the 10-year, but sometimes it just moves how it wants to move. And that's because ultimately, and we've inverted it here, ultimately this market goes up, right? Look at the monthly time frame. There's times where we see correlations between equity markets and what's happening in terms of the economics. But for the most part, we just see this market continue to push onwards and upwards. And therefore, there's question marks about how much this market's going to be impacted in terms of sentiment by small adjustments in terms of the view of whether we're going to see 3 rate cuts or 2 rate cuts or 1 rate cut or 5 rate cuts. That will adjust sentiment around markets. But by and large, people seem happy to be buying into markets in anticipation of that rollover in terms of the 10-year as the central banks start to cut interest rates later on in the year. So this is a market that by and large sometimes pays attention to the economics, but generally it just wants to go up. And that has been highlighted exactly here. We had a period where it tracked that US 10-year very well throughout 2023 as we saw that pullback, which of course I've inverted it here. But then it just carried on in its direction. And by and large, the concerns that we've seen for the US 10-year around about how many rate cuts we're going to see and that realignment has fed into FX markets, as we saw with the US dollar and the dollar index, much more than equity markets. So if you're looking for a trending market to get onto, equity markets by and large are much more likely to just ignore the economics and just want to keep going in one direction. And everything AI appears to be a key factor behind that. Another market that is key here is gold. Now, gold tracks the US 10-year much better. You can see that here. We have periods where it tracks it very well, other periods where it doesn't as much. Certainly recent sort of years, 2023, I think it tracked it very well. But what we've seen here recently is a divergence. We've seen the US 10-year pushing upwards, but we've seen gold, as we see, declining. But what we're actually seeing in real life, because this is inverted, is that we've seen gold rally up into record highs. And this, for me, is a similar kind of phenomenon to what we've been seeing in terms of equity markets, where we're seeing front running of what's going to happen down the line. It's pretty obvious that we will see rate cuts. The question mark of exact timing, exact degree to which they're cut at first this year, maybe some people don't really care that much, because they know that gold does well at times of monetary easing. And therefore, I expect to see a strong year for gold. Whether we see June as the first rate cut, or a little bit later where we see 3 rate cuts or 2 rate cuts, markets, as we can see here, don't necessarily, and I say markets essentially, that people buying into gold don't necessarily seem to be too concerned, and instead want to jump on board a bandwagon that has led gold into record highs. And so if we see inflation, the core PCE number coming in relatively strong, that could see upside in terms of the 10-year, and it could drive a bit of a pullback in terms of gold. But by and large, I think the trend is very much defined. So any pullback, people are likely to buy into that anyway. I think the long-term trend is established for gold, and I expect to see further upside. But if we see anything particularly like notably strong in terms of inflation, that could see a pullback in gold. But if we see a 0.2 figure or lower than 0.3 number on that core PCE figure, I would expect to see gold push onwards and upwards once again. The US dollar coming back as a result, and equity markets pushing onwards and upwards. Markets at the moment are pricing in a 0.3 figure for that core PC metric. That would point towards the Federal Reserve not necessarily being able to hit that 2% target anytime soon, and certainly by that June proposed rate cut meeting. But how much do markets care? Well, it depends on what you're trading, right? Markets care if it's the US dollar. Markets in terms of equity markets apparently don't really mind that much because equity markets continue to push onwards and upwards. US equities hitting record highs, gold hitting record highs. And so some markets, people are really front running that move, less so in terms of FX. So if you're looking for something that's really going to track what happens in terms of this release, pay a little bit more attention to the likes of the US dollar. But if you're looking for very clearly defined trends that could push through irrespective of the release, keep a close eye on equities in particular, like the S&P 500, and to an extent, the likes of gold and silver with precious metals.